Good morning, Alexandre.
Good morning, Anna.
Lovely to see you again. We're going to focus this time on three points to look out for this summer. The first being on oil, which is back again at $100 a barrel a couple of days ago and remains very volatile. What should we expect going forward on the oil price?
Well, our central scenario remains that we will see some kind of normalization on oil prices by the end of the year, where we expect oil prices to go back to around $80 a barrel and probably 75, 80 in the course of 2027. I think the key lesson actually over the past couple of months is that oil finds a way to flow. In particular, we have seen a lot of rerouting of oil exports from UAE or Saudi Arabia going through some alternative routes. There is also demand destruction in China that consumes less oil from the past. So I think that overall the sensitivity of oil prices to the Strait of Hormuz is not what it used to be in the past. And as a result, we still think that oil prices can normalize and will provide some support. So we remain invested in equities and we still think there is some upside on the equity market.
Okay, and so what does this mean for central banks? If there is higher inflation because of the oil price, should they hike or not hike?
Well, this is a big dilemma today for central banks. Mrs. Lagarde was quite reassuring in June when she basically said there are less secondary effects visible at this stage, and this is why she skipped hiking rates in July. So they remain data dependent. So if oil prices remain elevated at $100 over the summer, they will have no choice but to hike. It's September. I think this is still an open game. But our central view today is that there is no need to hike a second time in September at this stage.
And in terms of financial markets, gold has had a difficult year this year. What is our house view now on this asset class?
Well, we remain positive, and I think the level of conviction is a bit higher this time. You're right, we had actually prices going down quite a lot in February or March, particularly as some central banks had to sell gold to basically get US dollar to defend the currency, but this is behind us. Mm-hmm. There are two elements today that makes us a bit more confident on the price of gold. First of all is that the Central Bank of China has returned in buying gold. So when gold was at 5,000, 5,500, they actually stopped buying gold. And now that the prices have come down, they are buying gold again. So they seem to be a bit more opportunistic. The second element is that we are seeing actually ETF demand back in the market, particularly from India and China on the retail side. So from that point of view, gold still makes sense, and we continue to own gold in our portfolio. And it seems that we have reached a floor around 4,000.
Great. And a final easier question. Where are you off to this summer?
Well, I'm going to go on the shores of Normandy.
Oh.
So it's going to be a bit fresher, hopefully, for this summer. Normandy, which recently managed to get their D-Day beaches on the UNESCO World Heritage.
Oh, really?
So I invite you to visit this lovely region this summer.
Thank you very much. Thank you all for listening and watching. We hope you have a lovely summer. If you'd like to consult any of our expert views, please consult the monthly house review on our blog. And we look forward to seeing you in September. Thank you.